90 days or 120 days operating cycle, which is better? Let's understand with this case. X Limited is having an operational cycle of 90 days, whereas for Y Limited it is 120 days. Assuming both the companies are in the same line of activity, which company is in a position to make more profit? Which company could be in more advantageous situation here? Look at here, X Limited, they invest in their operating cycle, and whatever they are investing in operating cycle, they will get back in 90 days. And when they get back that in 90 days, they will get an opportunity to invest once again. It means they have completed 2 cycles now, and they will get back opportunity to invest once again. So another 90 days, 3 cycle, they will get back opportunity to invest once again. So 4 cycles. It means they are investing in 4 cycles. So what does that mean? They are having opportunity to make profit 4 times in a year, right? Because in one cycle they are investing money, cost is incurred, sales are happening, and that is going to bring the profit, and that is repeated here. It means they are getting opportunity to make profit 4 times, and all the 4 times they are collecting money, right? So it is getting repeated. It means their liquidity is going to be more, and their funds are getting locked in the cycle for how many days? Effectively for 90 days only at a time. So if at all they have to borrow any money to take care of the funds that were locked, it is only equivalent to 90 days of cycle investment. So they will borrow only for 90 days. As a result, the borrowing cost will be lesser because it is only for 90 days period. But if you compare that with Y Limited, things are going to be different. Y Limited is having a cycle of 120 days. That is, from the raw material holding to work in progress to finished goods to debtors and then to cash. It is taking 120 days time for them. So if they put money now, only at the end of 120th day they are going to get back that money, and then they can put that in the second cycle, which will take another 120 days, then goes to the third cycle. It means their cycle itself got reduced to 3 times here. Look, cycle is only 3 times, whereas X Limited had 4 times. Now, as the cycle got restricted to 3 times, they're also going to get opportunity to make profit only 3 times in a year. And funds are locked here for almost 4 months, right? It means they will have less liquidity because most of the funds are locked in either inventory or with the customers. And since money is locked for almost for 4 months, they have to borrow more money when compared with X Limited. And since they have more borrowings, their borrowing cost will also be more, and as a result, the profit will be less here, whereas here it is for X Limited, profit will be comparatively more. And here we go, Credit and Financial Analysis Mastery course. It's a comprehensive pre-recorded online course that comes with 15 modules of video lectures, basically 70 plus hours of video contents, multiple ebooks and reading materials related to credit and financial analysis that will make up another 30 plus hours of content. So totally it is 100 plus hours of learning resources. Then you will also get access to a private community in Telegram for clarifying your doubts in credit and financial domain. Then you also have the flexibility to choose 1-year subscription or lifetime subscription depending upon your learning goals. So by joining this course, you will learn basics of credit analysis, how to read balance sheet, financial ratio analysis, cash flow, fund flow analysis, how to arrive at credit risk rating, how to prepare CMA report, cash budget, how to assess credit facilities like CC, OD, LC, BG, term loan, how to write bank loan proposal, and you will also have access to case studies related to credit analysis. So to join this course, to know more about the course, comment CFA, and I'll share the details with you.